The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is a United Podcast Network.
Welcome to Easy Money New England.
Oh, can somebody help us here?
We can, because we are real estate and mortgage professionals.
Here you go. Just come in and browse.
That's right. Come on in, listen up, and learn.
How long do you intend to browse?
In a short period of time, our panel will teach you some tricks that might make your house buying easier.
You don't ask her how long she intends to browse.
You might not be looking for a mortgage today, but we'll get you ready.
You don't look like browsers.
Are you looking?
Oh, what do browsers look like?
Yeah, maybe I'm half browse.
On his father's side.
This is Easy Money New England
Let's show the lady we're browse.
with your host, Brian
Hey,
DAmico.
look at us, we're browse. One more word out of you and he gets it, all right? Come on.
Welcome to another edition of Easy Money New England, where every week we bring you money-making opportunities or money-saving tips, anything in around the industry of real estate. And today with us, we have Chris Nobile. Chris Nobile has been very instrumental in helping New Fed Mortgage, my company, grow through the years. We've known each other over about 15 years now, and he's been a great, his knowledge and professionalism and really helping his clients. You know, his clients are mortgage companies, but he also gets in front of people, does large seminars. And I can't say enough good things about Chris Nobile. So, Chris, welcome to the show.
I appreciate it, Brian. This is really, really great to be able to kind of work with you side by side in a little different environment. The opportunities really to kind of get information out and really help people make good decisions is so crucial these days.
Yeah, so really the topic of our show today is, you know, customizing your mortgage and reducing that term to make it work for you, but also save a lot of money in interest.
Yeah, the thing that we were talking about the other day is you were kind of lamenting the end of the year here, getting everything done along with all the holiday obligations is, you know, this is also a time when people start to think about, okay, long term, where do I want to be? And you're selling and financing homes that people are taking out a 30-year mortgage. And, you know, if you're in your early 40s or mid 40s, you're thinking about, my goodness, actually, when I finish paying that off, I'll be past retirement. Is that really where you want to be? Is that really what you want to deal with?
Not many people, if you're driving around, not many people want to be paying a mortgage in the retirement years, I'm sure.
Well, and so how do you go about that in a way when we're all looking at the budgets today? And one of the places that I like to encourage people to think about is the tax benefits, and we'll kind of put the whole tax, you know, what's happening.
We won't talk politics.
No. That's fine enough. But the reality is that the tax deduction for your mortgage is a great driver on really how that fits into your budget. And one of the things that I've observed in 30-some years as a retail originator previously and now on the correspondent side, kind of behind the scenes, is that a lot of folks really don't know the after-tax cost of that mortgage. And that's an important thing to consider.
So how long have you been in this business?
37 years.
37 years.
Yeah.
Wow. So you've seen it all.
Well, and just kind of a quick aside for that, you know, everybody talks about market cycles and how, you know, home prices are going up and up and up, and will they continue to go up? And like yourself, you know, we see how these cycles, they seem to peak and then there's a drop, and yet there's a recovery from it. And I think back over those 35 plus years, you know, we thought the market peaked out in 86, and then there's a drop, and then you know, it peaked in the mid 90s, and then there was a drop, and then it peaked in 2005, and there was a drop, and now here we are again. And I think it comes to that, it's a long term, the best investment you're going to make.
Real estate by far, I think, is the best investment. Something you can feel, you can touch, you can see. Not so much with the stock market. You never know. I mean, you can wake up and overnight, you know, today Bitcoin's down 10%. I mean, right. You know, you don't really get those fluctuations overnight in real estate, but you know, you've seen it through the years. So, you know, in times of uncertainty, you know, I think people's strategy would be to pay off debt as much as they can. And, you know, you're coming up with this concept of customizing your mortgage, what's right for you. I mean, where does it start? Do they have to have a goal in mind, and kind of reverse engineer, or do they come out and just say, hey, look, I just want to shorten my term?
Well, I think there are a couple of ways you go about it. The first place I would say, and this is what I really like about NewFAD, is that your loan officers think about the individual and talk to the individual about what their situation is right now. It's not cookie cutter. And so when you sit with somebody and you see kind of where they are, maybe they've got a family situation where it's growing, or maybe their kids are just about ready to hit college, you can start to talk about some of those goals and then kind of find an end number and say, well, what would your financial situation look like in 20 or 25 or 30 years? How do we help you get there? And then you start shifting the conversation away from just what do I qualify for a new loan, but what can I feel comfortable in a budget? And think about your mortgage as really an investment, not an expense.
Right. So some people out there right now, they'll do a biweekly plan, or they'll make extra principal payments, or they'll do something that we had previous weeks where they could take an equity line and use it to pay off their mortgage quickly. But a lot of people out there, they just want a payment. They just want to make it every month. They don't want to think about it. Mm-hmm. And if they can just set that up correctly, when they'll know by the end of that term, they're clean.
That's right. Well, and then think about this too. Again, from an aging thing, and this is a guy that's a little closer to getting his mortgage paid off than starting off. We'll leave it like that.
37 years in the business.
Have refinanced a few times. But you look at this from a practical standpoint, and you say, all right, as time goes on, the future value of money changes, and so what a dollar is worth today versus a dollar in the future. So you think about that mortgage payment. If that doesn't change, it's going to incrementally get cheaper because of inflation, even at a low rate over the next 5, 10, 15, 20 years. So a mortgage payment today that might feel like it's a little tight, given just the standard pace of inflation, is going to be easier and easier over time. So if you kind of get that in your head right from the start, it's easier to have these discussions. And as I say, I think the starting point with that is really the tax deductibility. One of the things that I know your folks often use is a little tool I put together, which just says, take your tax bracket, look at your mortgage payment, and see what the tax deductibility is. And a real simple illustration of this, and I would encourage folks to contact Brian and his team to walk through this. But if you assume a 25% tax bracket, that means that $1 out of every $4 that you pay in interest, you're going to get back in tax refund, in essence. And if your mortgage payment, certainly the first 5 years, is about 95% interest, that means a $2,000 a month mortgage payment is almost entirely interest. If you're getting a tax deductibility of 25% of that, that means in reality, while you're paying $2,000, you're going to get back $500 in lower taxes. So really your out of pocket is not $2,000, but $1,500. And suddenly that's a different calculation when you look at affordability, right?
Right. And you see many people that don't really need to take out mortgages, but they do anyway. You see celebrities, you see athletes. They're taking mortgages because they need that deduction.
You take that deduction. So now when you're sitting with when your loan officers are sitting with somebody, and you say, well, $2,000 is about my, what I'm comfortable with. You say, well, but after taxes, it's really $1,500. Maybe you can go a little larger. Maybe you can get that a little more house, or maybe doing that refinance to take cash out to pay for some of that college education. And I just, again, as an aside, I've got almost an 18-year-old. We're looking at college tuition, and you look at, you're going to get loans for college tuition. Boy, I'll tell you what, it's a lot more inexpensive to do it through your mortgage. So again, that deductibility is really important for folks to recognize and to calculate in.
You're talking about a value of $1 back when colleges were a lot less money. Now it's quadruple from the time I remember.
Yeah.
I don't have children in college years, but I'll have it soon.
Yeah, it comes fast.
It comes quick.
Yeah, and start early.
Yeah.
But really, there are reasons to think about using your equity in your house. And again, we keep sidetracking a little bit here, but properties have rebounded significantly. And I think folks are much more prudent. They're not using their homes like ATMs. But it is an investment opportunity because remember, every dollar that you're paying down that mortgage principal is really a dollar that you're putting in your pocket at the same time that house is gaining value over time. So you're pocketing value opportunity. And when it comes to as I say, colleges these days, state colleges are no longer a few $1,000s.
Right.
They're $15,000, $20,000. That's just for a state college, let alone a private. So thinking about using that equity drawing is really important.
That makes a lot of sense. But, getting back to customizing it for you,
right.
I see some of the savings. If you go from a 30-year mortgage to a 15-year mortgage, I mean, it's drastic.
It is. Although, one of the things that I think I remember hearing when I was writing loans all those years ago, and hear it from your team too, is that folks, when you look at the difference in the payment between 30 years and 15 years, folks go, yeah, I know, but it's a little too much. And so that's where trying to fit it in and say, okay, now when are my kids going to be out of college, or when do I expect to retire? And chipping a few years off the end of that loan, literally taking 2 or 3 years off on a $300,000 loan can save you $7,000, $8,000, $10,000. That's real money over time, and just as importantly, it syncs you up financially. Who wants to be at the point of, well, I can retire now, except, I've got this mortgage for another 2 years, so I need to generate a little more income. If you sync that up or sync it up with, people who have their own businesses, one of the other interesting things that is happening in our economy is the number of folks who are self-employed, and so or generate their income in a way that isn't salaried. Something like 27, 28% of people derive their income other than kind of a regular, I'm working for somebody.
Yeah.
Which means that's a business that they might sell or pass on. And so kind of coordinating your mortgage payments with the timing of that long term for estate planning, also a really smart thing.
Yeah, you bring up a good point because, going from a 30-year to a 15, although it may be drastic, you can actually pick 16, 17, 18. You can figure out which payment makes more sense for you. And granted, there's pricing benefits if they go from a 30 to a 20-year, or say 20-year to a 15-year. Those are the pricing breaks.
Right.
But anywhere in between those areas, all the way down to a 10-year, they can pick their term and see what makes more sense for them.
Absolutely. And the reason why there are those differences in rates is those loans, as you shorten the term, tend to stay on the books. People don't refinance those as often. So that has more value to the servicers. That's who I work for. And so willing to offer a better price for that because we know that loan is less likely to refinance out. And the other thing is that people who take shorter term loans incrementally have a better payment record. There are fewer late payments and defaults. And finally, it also is one where I think there's just more of a financial commitment. That person is more tied into that.
And, the shorter the term, the more interest they'll save. I mean, I saw a couple graphs. It was about a quarter of the amount of interest that they would pay over the course of a 30-year mortgage as opposed to a 15. Right. But, it is tax deductible. So, I'd rather get that paid off sooner.
Right. There's a balance. Yeah. The balance there. Again, the first 5 years, something like 95% of your mortgage payment is interest.
Yeah.
So great, you get that deductibility, but you don't really get into heavily paying down your principal till you get to 12 and 15 years in. And by shortening your term, you can start to pick that equity build up a little sooner. And again, it's sort of like, in a good way, burning the candle at both ends. Yeah. By paying it down a little more quickly and you're seeing that homes are appreciating, you're building up that equity in a home, and that's really your investment. That's your return.
Is it better, boys, to...
Here's Mr. Jonathan.
That's right, the unsilent majority over here.
Right.
In your estimation, Chris, would it be better to pay down a 30-year mortgage in 15 years, or would it be better to get a 15-year mortgage?
You get to the same destination with that. The advantage to a 15-year mortgage right from the start is that you have the discipline, and as time progresses, it's easier and easier, as I say, because of time and inflation, your paycheck and sort of relatively speaking, that becomes slightly more affordable. If you take a 30-year and pay it down at 15, you've got to take extra action, which means each mortgage payment you're going to need to add principal to. A fairly simple thing, and again, Brian, your folks have that tool.
Yep.
So I'm always an advocate of trying to go with the shorter term from the start, because the other thing is you pick up that little rate advantage that we build in as service.
So you get a break on the rate if you go with 15.
Yep. It's absolutely. Yeah, it's usually a half to, could be more.
Yeah. It really and the other thing is we're in a very heavy trade up market. I know your folks work in all these communities, but in the trade up market, what we're finding is that people aren't qualifying for mortgages at the maximum level. They pretty much come in and say, well, here's what I want to pay for the mortgage. And they certainly have capacity to get a larger loan, but choose not to. Those are the folks that, I really would encourage to think about shortening that term. If not going to 15, as I say, chop 3, 5, 7 years off of it. Take a little bit off it because you've got the capacity.
And Jonathan, to your question, I mean, consistency is usually the best.
Sure. I
know many people, I'm going to do a 30-year and I'll just chop away. They never chop away.
Right.
I'm also, to blame on this one too. Like, I don't do it myself. I said, I'd rather do a 30 and chop away, but then life happens.
Yeah.
So it is a good opportunity to say, hey, I know this is my mortgage payment is every month. I'm going to be free and clear, in 15 years.
Right.
Could be 12 years, could be 18 years, whatever they want.
Well, the thing to look at that incremental difference in the payment between going the 30-year and taking that shorter term. Think about that not as an expense, but as an investment. And so when you start to look at that, and again, your folks have the tools, they can walk your people through that. But when you do that and you say, all right, I'm paying $300 a month more, however, I'm building my principal, that's really a yield on that. So if for every $300 you're paying in, you get $50 or $75 more principal. That's an investment return of 8 and 10%.
It makes a lot of sense. I mean, it's a lot of people don't know this, right? So if you're driving around listening to the podcast and you want to get started, call 1-877-NEW-FED-1. Again, 877-NEW-FED-1, and just tell them you heard our podcast. You're looking to get started. Jonathan.
Yeah, my last question here, and unless he says something profound and sparks something else, is there a tool you had mentioned early on in the podcast here about figuring out what you really are paying for your house after your tax? Is it savings that you're looking at there, and is there a tool to figure out once you've taken all your deductions how much you're really paying?
The easiest, quickest answer to that is simply right now, and even with the new tax proposals out there, you're going to be able to do this very simple thing, which is you can calculate how much interest you're paying on a loan. Your loan officer can provide
look at the amortization schedule, right?
Right.
So every loan has an amortization schedule. You can kind of see the whole picture of that life of the loan.
So you just take that number times your tax bracket, whatever that is. Again, you can look at your previous year tax return, and that will tell you, again, since just multiply that by the amount of interest you pay, that's what you're going to get back in terms of reduced taxes. So that's, less dollars out of your pocket.
So in the end, with how low interest rates are right now, buying a house is easy money.
Well, we like to say there's no such thing as easy money. I mean, if there is, let us know, call us up.
It's good money.
Yeah,
it's good money.
There's easier ways, but I still haven't found that easy money. Unless Bitcoin,
Yeah,
that seems to be easy money right now. But how long, if that can withstand, it's doubtful.
the bottom is bound to fall out of that.
Well, you actually bring up one other thing that I'd like to kind of interject here, and that is that there's sort of an anomaly of shopping for mortgages. One of the fascinating studies that was done last year was really how frequent people comparison shop. And amazingly, guess what the two things people shop most frequently and most intensely for?
My guess would be a television or a car.
You're right there. Electronics.
Yeah.
Cars are up there, and flights and airfares. Hotels.
Flights and airfares.
That literally 2/3 of consumers shop 2, 3, 4, and those are the things they do the most comparison on. Yet mortgages and loans are literally only about 1 in 7, 1 in 8 folks actually shop.
Is there a huge difference between mortgage companies on rates?
I think there's different concepts. Like for example, you hear these other large national companies saying, come to our call center, basically, and cut out that mortgage originator. And there's some value there, but a loan officer can bring you a lot more value. I mean, listen to Chris talk about some of the things about your financial goals.
Right.
It's only so much you can get from a call center or a robot or
right.
artificial intelligence. So I mean, you definitely want to shop the originator, but most companies are pretty similar. You'll see if you call around that they're pretty similar, unless you go to a out-of-state call center, and even then, you still want to close on time. And
yeah, you just never know what you're going to get when the person doesn't have to look you directly in the eyes. There's something to be said for that.
Yeah, and I deal with companies throughout New England, the Northeast, for the past 20 some years in this capacity. So I see how they operate. And, for the most part, they're very good firms and lenders out there, banks, mortgage companies, and so forth. But the difference really is it's like stepping into, a restaurant. It's the level of service. It's the attention to detail. The price may ultimately be close to the same, but how do you feel walking in and walking out of the door? And having knowledge about where their financial situation is, being able to provide these sort of comparisons, and encouraging people to really understand the value of when you make these choices. That shopping for the last couple of dollars is less important than knowing that I'm getting that quality service and I'm getting that support.
Also, what an interesting stat that I read was, one of the national companies, they say, do your mortgage online, only 3% of the people actually go through that process. It's more of a lead generation tool than it is a whole process from start to finish. Yeah. So there may be some marketing out there that isn't absolutely true, and we'll see what happens in years to come.
Right.
But you definitely want that professional look. You definitely want to make sure the loan officer is in your best interest.
Yeah. It like any kind of financial service, we want it at a value. But at the end of the day, if something is important to me, being able to have that personal connection it is crucial. And again, when you look at the mortgage process and then kind of servicing after that, that's something that is very important to folks. And again, I think shopping and making those comparisons and asking those educated questions is really crucial, because that decision you're making today is probably the largest financial decision you'll make in your life. You think of it as an expense, but really it's an investment, because at the end of it, you've got a return. You have money.
Right. So if I'm driving around or listening to this podcast another way, I'm not sure how they would listen to this otherwise.
I heard some people listen while they're jogging.
Well, they're jogging.
There is that possibility.
I always thought I would do that, but I haven't done that yet. So it's usually only when I'm driving. But if I'm driving around now and listening to this, or I'm jogging, what's the benefit? Not so much the benefit, but geez, I'm totally spacing it, Jonathan.
Take your time. There's no rush.
So here it is. So what's the benefit? If I call a mortgage company, I just call them up and I say, what's your rate? Because that's really what people do. Their first question always is, what's your rate? What are some of the things that go into that? Right. So you can't, when you shop for a mortgage, you just don't say, what's your rate? Do they lead in with some information so they can get a little bit qualified, so they understand that it's apples to apples? Also, when they shop for a mortgage, the rates change daily.
Mhm.
I mean, they change sometimes 2 or 3 times a day.
Right.
So you want to make sure that you're comparing apples to apples, right?
Right.
So, if a customer calls in today and asks for a rate, and we do the little workup, give them a rate.
Mhm.
If they check tomorrow somewhere else and say, hey, this guy's rate's lower, well, the rates went down overnight. So, I mean, no one controls that, right? So let's
Yeah.
talk a little bit about that.
Sure, I'd be happy to. And these are sort of behind the scenes things that I really am excited to share with folks, because it seems like it's a mystery, and it really shouldn't be that much of a mystery. And by the way, just as an aside, I don't know why I think we in the industry kind of fall into the kind of the trap of it's always about rate first. I mean, people don't go out and shop for the cheapest house. They don't go out and necessarily shop for the cheapest car. They shop for a price range and then try to find the best value in that range, right? It's not always about finding the cheapest pair of socks.
Right.
And when it comes to mortgages, there are a whole bunch of ways to kind of come in through the doors. What I would encourage people to do is, first of all, give people an understanding of how much knowledge do I have? Listen, we all can go on the internet. We can all look things up. But if you've not been through the experience, or it's been a number of years, the first place I would start is to say, tell me about your process. How does it work? What are you going to do to help me through this process most efficiently? That engages you in a conversation about the value proposition. And then you can start to move to the kind of the scope of options. So I think that's the starting place. And certainly, if you have information on your credit profile or the amount of funds you have available, or some of the other considerations, then you can weave that in. But I think it's that starting point. And then let that loan officer kind of start to fill in that picture. That's part of the initial shopping. If they start to respond to you in an engaged way, as opposed to kind of going through that checklist, that should tell me something. And I think in terms of the cost, I mean, one of the things that has happened over the years is that there's been a lot of governors put on sort of the scope and how costs are disclosed, right?
Oh, yeah. Oh, yeah.
Look at your back row.
It's been quite the knee-jerk reaction, but it's helped.
Yeah, it has in the sense of like everything is disclosed 5 times over. I think there's a lot of overkill, but there's a lot of explanation there. And the other thing I would encourage people to do is call your loan officer once you get the information and the preliminary discussion. Have those engaged discussion about what happens next. There is kind of a conveyor belt to the process. Kind of getting back to your core question about rates and so forth. Mortgage rates are a security, right? So it's no different than stocks, right? Stock prices change every day. Interest rates change every day. So in talking to the lender, the other part of it is making that decision. Is this a rate that I want to secure today, secure 30 days or 60 days from now? That's all going to depend upon when you choose is your kind of lock-in or settlement date. And because rates move in a little bit of an unpredictable way, that's, again, one more reason to look and understand who that company is and who you're working with.
That makes a lot of sense. And a fun fact for you is, mortgage rates closely resemble the 10-year bond. When you see that 10-year bond coming down, that means interest rates are coming down.
Right.
When that 10-year bond's going up, that means interest rates are going up. So it's a good indicator. It's not, right on the spot, but it's a good indicator of which way they're moving. And one of the major things that I see from loan officers' point of view, from other companies, obviously not our own, but if that loan officer isn't asking you how long you plan on being in that house, I've seen instances where someone wants to refinance, they're going to a 30-year fixed rate, but they only plan on being in the house for another 2 years.
Yeah.
If you're only going to be in the house for 2 years, or up to 10 years, you need to tell your loan officer that, because you will get a big interest rate reduction, basically, by choosing an adjustable rate term. I mean, I know that they got bad,
they got a bad rap.
They got a bad rap over the years because of the exotic products that were out there in the past. But if I know I'm going to be there in less than 5 years, I'm going to do a 5-1 interest, 5-1 ARM, and my interest rate's going to be low because I know I'm selling that house within the next 5 years. So
crucial.
that's a big benefit when you talk to a professional.
Yeah, absolutely agree. And again, that's if you start off the conversation about where you want to go and help them through the process. If that loan officer is good, they're going to pick up on that and connect with that. I think the other thing about interest rates is, we're kind of at the bottom of the trough. I mean, if you look at them historically, trying to buy at exactly the bottom is really a matter of random luck, right? It's just like buying stock. We're now at a point where, give or take an eighth or a quarter%, these are as good a rates as you're going to see. And so sort of trying to time it with that last piece, to me, particularly as time moves on, the risk is more and more up, right? As pressure builds, and we know the Fed's going to be making some moves next year, that's going to impact interest rates. All it takes is something internationally that gets folks nervous and rattled. Right. The markets move not necessarily on news, but how they feel people will respond to news or what the anticipated impacts could be. So, my approach has always been, if it looks good, take it.
Right.
Because that risk exposure gets stiffer and stiffer.
So if you're thinking about buying a house, jump in now. I mean, it's a great time. Interest rates are low. Yeah, the value is a little up there, right? But is it all relative, Chris?
Well, we said that in 2005. We said that in 96. We said that in 86. And yes, they peaked and dropped, but then came back again well beyond. I mean, how many homes that were at the top of the market in 2005 do you wish you had bought?
Yeah.
Right? Because it came back. And it's the same sort of thing. And so when you tie that to interest rates, you have kind of something that balances that a little bit with the rates here. When an interest rate moves up, every 1% increase in interest rate is about a 12 to 14% increase in your payment. So that's no different than the house price going up by 12 or 15%. And so, when I look at that and say, what's the value of waiting? Well, not only don't you get the benefit today, but you also risk that upside, which just undercuts your value.
Right. And if you have the fluctuations of values in the housing market, many people don't care because, their payment stays the same. Nothing changes. And if they're not thinking about moving anytime soon, they're going to fluctuate all the time. They don't really care because they're just making their payments.
That's New Englanders anyway, right? Right. We tend to, we tend to stay put.
Yeah.
And it's a good thing. And especially in the market that we're in here, unlike the rest of the country, you're not adding a lot of new supply, right? So that's really what's undercut the market in other parts of the country. When the dips happen, there's this huge oversupply of homes. We don't have that. The average, I just saw the other day, the average time a home stays on the market in Massachusetts is, I think, under 2 weeks, right?
Under 2 weeks. Oh, I believe that. I mean, today we're in New Hampshire. It might be a little different. They may have some land up here.
Right.
But, I mean, the New England market in general, I mean, it's not like your West California or where they're buying homes and they can't even cash flow on multifamilies and that type of thing. So, yeah, it's very interesting. So, Mr. Jonathan, I know you're a minimalist.
I am a minimalist.
And you're going down to the double wides.
When it's time for me to buy my double wide, is there a list of 3 to 5 things that I should be showing up to the loan originator with to make my life easier and make the process a little streamlined?
Well, let's say not a double wide because those are not specialty. I mean, you got to find a specialty program.
What are you trying to say? You're not into the double wide scene?
Let's pretend you're going to buy a single family.
All right, single family. It's a little big for my taste, but single family. So is there a list of 3 to 5 things, credit score and so forth, that I should bring with me and have at the ready to streamline the early process?
Go ahead, Chris.
Well, the first thing is just if you can pull together your income information. That is, your most recent pay stub, maybe a W-2 from last year if there's sort of overtime or something that kind of shifted in that. Certainly having, your mortgage statement if you currently have a home or your asset statements. What's fascinating these days, though, I have to tell you, Jonathan, is there's a new tool that Fannie Mae, which is the ultimate Fannie Mae and Freddie Mac, which really service most of the loans ultimately. They put this thing out called Day One Certainty, which is a very fancy term that it's almost a little scary what it does.
We're going to invite you back for when Day One Certainty is in the mainstream, because this is pretty crazy what's going on.
It's groundbreaking.
It's groundbreaking.
It really is. So it will. What it really does is it takes that onus off of your shoulders to bring in this information. It all grabs it right from your existing vendors and holders. But for the moment, yes, your pay stub, your bank statement, knowing your credit score is good, but and it's free to get, but don't go out and pay for it for sure.
Right.
The
mortgage company, the mortgage lender is going to have to pull that credit report no matter what. So, sometimes people will come say, I have my own credit report. Well, we're going to have to pull our own anyway. Same thing that goes with the appraisal. We're still going to have to order a new appraisal. But yeah, with that information, you'll know right off the bat. You can get to the point where we're disclosing the loan. You get to see all the paperwork and go through it, review it, and then make a decision.
Because as you've said before, people typically find the house before they find their loan originator. So, if you can get yourself into a situation where you can streamline those early processes.
Yeah, I mean, we
right.
come from the schools. You really do want to meet with that loan originator first.
Right.
But we know what happens. People drive by, they see a house, oh, geez, that's a great house. I want to buy it. And you backtrack it a little bit, right? But it'd be so much better if you knew that you already had a loan officer and you could just call them and say, hey, look, I found a house that I really like. Can you break down the numbers for this before I go see it? Yeah. Because now they know exactly what it's going to cost them before they walk in the door.
Right.
It's a huge difference.
Do you find that would give the prospective buyer an advantage over perhaps other buyers, that they have all the information at the ready?
Well, yeah, because, I mean, if someone goes in there and they say, I like that house, I want to buy it, and then they go through it and then they didn't realize that the taxes are through the roof, or it's in a flood zone, or, they don't know these things up front. They walk in and they say they want to buy it, and then they're backtracking, finding out that it's way over their budget, and they don't qualify for it. So it's a much seamless transition when you're going into, when you come up with your plan before you go shopping.
Information is power.
And I'd add one other thing too, which is you lose the opportunity for that loan officer to be an advocate for you. The other part of it is that if you're qualified and you've got the loan officer there, you have a much more powerful application and kind of pitch to that seller. Especially think about the market here, right? So you got all these people are descending on this open house. You've got multiple bids there. If you're on the outside trying to connect up with my loan officer, that's time, and that doesn't give you a chance to move quickly and firmly. So I would say in this market,
especially in this market,
you do kind of handicap yourself if you're not in there making your best presentation, whatever that is. That's what you get when you start with a loan officer first.
Good point. So, Chris, it was a great topic today. It was great for you to come down here and talk to us about, a lot of things. Really, customization of your mortgage and the benefits by using a loan officer has been great. I mean, in closing, do you have anything that you'd like to add?
Well, two quick things. One, I'd love to come back and talk about Day One Certainty when that's rocking and rolling.
We're definitely going to be all over that.
Great. And the other thing is, yes, talk to your loan officers. I just can't emphasize enough. The more people kind of engage that discussion from the start, they'll have a better experience with it. Getting a mortgage today is easier than it's been in the past 10 or 12 years. Believe me, you'll experience that.
Great. Fascinating. Jonathan, you have anything to add?
I got nothing. Chris, I had 10 questions. He answered them all as soon as I wrote them down. He's very good. Very good.
We could go another 3 hours with Chris. He's got a lot of knowledge.
There he does.
Thanks, guys. Appreciate it.
Thank you, sir.
You got it.
And there's no such thing
No
as
such
easy
thing
money.
as easy money. If there is, shoot us an email. info@newfed.com. Animals number 1881.
It's a new day, it's a new way. Call 877-NEW-FED-1. It's a new way.
Hi folks, it's Brian DAmico, owner of New Fed Mortgage, and I'm really excited to introduce Fast Track Mortgage, our new online system that gets you approved in less than 15 minutes. Whether it's a refinance or a new purchase, just go to newfed.com anytime, day or night, and click on the Fast Track Mortgage button. Fill out the form, and within 15 minutes, we'll approve your loan at the lowest rate possible. Don't waste time dealing with big banks. We're local and here to help you close your loan fast. Just go to newfed.com 24/7 and get approved in less than 15 minutes. Fast Track from New Fed Mortgage. Now that's a new way to get the loan you need fast.
877 New Fed
Subject to credit approval, Equal Housing Lender, NMLS number 1881. Call us to the website for details.
877 New Fed 1.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.